Hi, it's Brad with Ocean Consulting Services. In today's video, we'll be talking about IRS tax liens. What are they? How does the IRS use them? And we'll run through a few examples that will give you some idea as to specific areas where the IRS utilizes liens. Typical scenario involves the IRS placing a lien on your house. And the first question I get is, does that mean the IRS will take my house? And it does not. What it means is that they have a right to take the house. They have a right to collect their debt and use your house as security, but does not mean they immediately intend to seize your house. Typically, taxpayers have to really ignore the IRS before it would ever come to that. So let's start off with the U.S. tax system. It's referred to as a voluntary tax system, and I put that in quotes. What that means is you are expected to file your return, pay any taxes without the involvement of the government. Of course, if you don't file your taxes, the government will get involved, but for the most part, taxpayers voluntarily file their taxes and make payments. So what happens if you file your taxes but don't make a payment? Well, the IRS has what's referred to as a 10-year collection period. So that is referred to as a statute of limitations. So they have 10 years to collect the tax once it's formally been assessed, and we'll get to that in a minute. 10 years, and after that date, they have no right to collection. So typically, obviously, the IRS will work within that window and try everything they can to collect. If they're getting up near the statute of limitations with no response from a taxpayer, that's when you get into seizures, liens, levies, taking your property. But clearly that can be avoided by dealing with the IRS directly. So let's talk about this concept of assessment, because the 10-year period runs from the time that the tax is assessed. So what's the typical scenario? A return gets filed, taxpayer doesn't have the money to make payment, so the IRS sends you an invoice, a bill, and says a demand for payment, says within 10 days, please make full payment. If no full payment is made, now the tax is assessed. That's a sort of a technical term with the IRS, but it means that from a legal standpoint, the 10-year statute of limitations starts to run for collections. And it also means, importantly, that a lien is automatically created for all of your assets. Something that people don't really understand or think about, but as soon as that tax is assessed, the IRS has a right to all of your assets. Anything you have a right to receive, the IRS, they call it step into the shoes, they step into your shoes with respect to those assets. And again, it does not mean they immediately start seizing your assets or putting a levy on your wages, etc. It just means that they have the legal right to take actions and a legal right to your property. Same rights you have in the property, the IRS obtains. Now let's go through a couple examples to sort of put this in perspective. Let's take a typical scenario. Say 2019, you purchase a home. Say it's $300,000, you use $60,000 in cash and borrow $240,000. April 11th of 2021 rolls around, you file your 2020 taxes. It shows a tax payment due of $10,000. You don't have the funds to make the payment, but you file the return. Now on April 16th, sort of the April 15th deadline has come and gone. The IRS demands payment. They send you a letter. And then 10 days later, April 26th, you have not made a payment because that's the reason you filed the return without a payment. So now the IRS assesses the tax. And what happens is they refer to this now as a silent lien is created automatically. So I mentioned before, IRS, once they assess the tax, obtains a lien, but they refer to it as a silent lien because at this point, nobody except you and the IRS knows about the lien. So now what happens? The IRS collections division gets involved. They find out you have an interest in real estate, so they file a formal lien notice with the Registry of Deeds. And this is what is, this is the first public notice that you have a tax debt to the IRS, and that the IRS has a legal right, some legal right with respect to your real estate. They may also file another statement indicating their right to any of your other assets, but the typical asset that the IRS goes after is your residence. And what happens? So now you say, well, I've got this lien out there, I want to take care of it. So I'm going to sell my home. And again, the IRS isn't mandating you sell the home. This is just a decision you take. You want to get rid of the debt and maybe some other debts, and you decide to sell your home. So at this point, house is worth $350,000 and your mortgage is paid down to $230,000. So now what happens? Is the IRS entitled to the whole $350,000? So in other words, they have this lien when you sell the house. Do they get the whole $350,000? No. As I mentioned before, they step into your shoes. So just like if you sold the house, you wouldn't be entitled to the whole $350,000. You'd have to pay off the first lender before you were entitled to anything. So house is sold, the first lender gets taken care of, and now there's a balance of $120,000. So then the next question is, does the IRS now have the right to that $120,000? The answer is no. They have an interest in the equity, but only to the amount that they're owed. So assuming no interest and penalties, they'd get the $10,000. You'd get to keep the $110,000. Again, they're stepping into your shoes. So anything you have a right to, IRS obtains a right to, but it doesn't put them ahead of anyone else. So your lender for your home still has a first position in terms of seniority. All right, so now another example. 2019, you purchase an RV, $30,000, $5,000 down, and you take out a $25,000 loan. Same situation, you owe the IRS $10,000. Now you sell the RV when it's only worth $25,000 and the loan amount is $22,000. So that gives you a net equity of $3,000. In this case, the IRS does obtain the entire $3,000 because you owe them $10,000, and you still haven't satisfied the debt, so the $7,000 remains outstanding. Another example, you have an IRA balance of $15,000. You're under age 59 and a half, so you can't withdraw the money without incurring a penalty. So the question always is, isn't that protected? And in some bankruptcy scenarios may be protected, but in terms of the IRS, no. The fact that you would incur a penalty does not preclude them from counting that as an asset and taking an interest in it. And the fact that you would incur a penalty on taking it out is irrelevant. It's still an asset. Again, they step into your shoes. You could theoretically withdraw that money and pay your income taxes and any penalty, so they have a right to that. But now let's flip it on its head. You're with a company that only provides a defined benefit plan, so you don't have an individual right. You really have a right to this plan, and the employer says that according to the plan documents, you can't take a distribution if you're age 59 until you're age 59 and a half. So say you're below that age, does the IRS have any rights? No, they don't, because you don't have any rights. Now, as soon as you turn 59 and a half, and if you meet any other requirements under the plan and you are entitled to it, then the IRS obtains it. Again, the simple way to think about it is, do I have a right today to generate cash from this asset? If I do, then the IRS has a right to that as well. One more quick example with a gift situation. So your mother owns a parcel of land worth $50,000. She makes a legal transfer of that property as a gift to you. Again, no special status for gifts. If you have a legal right to it, the IRS has a right to it. They can file a tax lien against it. Could eventually compel the sale of that asset. Now just a quick wrap up. Notice of the lien. I mentioned before, the lien automatically arises once the IRS assesses your tax. So again, automatically, nobody has to do anything. You don't have to do anything, the IRS doesn't have to do anything. And again, but at this point only you and the IRS are aware of this tax debt and the lien against all your assets. So what the IRS does is they file what's called a notice of federal tax lien. So this is what people will get in the mail, and suddenly this is what starts all the public notice of the debt, causes debt people who help with debts to suddenly inundate you with offers. It also could impact your credit, and probably will impact your credit. Could impact your ability to rent an apartment. Could impact your ability to get credit. So again, filing of the lien doesn't cause an immediate seizure, but there are definitely negative consequences associated with that. So that's a quick discussion about liens. Next video and blog we'll get into how to actually get those liens released. Thanks, and please reach out to us if you have any questions, comments, or need any assistance. Thanks.